If you're trading Nasdaq futures or US stocks during the New York session and you're still struggling to nail clean entries, this video is for you. Most traders lose money because they chase breakouts. But the truth is, this simple pullback strategy could have made you $5,000 on Nasdaq and SPY last week, if you do it properly. And if you stay till the end of this video, I'll reveal the exact rule that I personally use to filter clean pullbacks from traps. My name is Brett Goh and I've been trading for nearly 7 years. And this year alone, I've made over $1 million in trading profits, all documented live on my second channel, Brett Trades. In addition to that, I've also helped hundreds of students become six-figure funded traders, and we are the only mentorship program in the entire industry with an endless scroll of student results and a 4.8 Trustpilot rating. Now, I don't want your money. I just want you to become a better trader. Let's dive in. Now, first of all, let's define what is a pullback, right? A pullback is basically a temporary pause or reversal against the main trend. It's simply the dip before the next leg. It's basically like a car, right? When a car eventually runs out of gas, it stops at a gas station, right, to get more fuel so that it can actually continue its journey. It's the same thing right here. What the pullback does is that it allows price to get more fuel before the next move actually happens, right? Before price actually continue to the upside and continue with the higher time frame trend or order flow. But here's the thing, not all pullbacks are valid. Not all pullbacks are created equal. And this is where so many traders get trapped. Now, if you cannot categorize the pullback right in front of you, you're basically trading blind. So inside my market mechanics playbook, I pretty much break down all the pullbacks into 3 different categories. Mainly fast pullback, slow pullbacks, and liquidity sweep pullbacks. Now, fast pullbacks are basically the weak ones. So in a fast pullback, what happens is that price creates like a breakout structure to the upside just like this. But then the pullback is insanely fast, right? You'll start seeing a lot of bearish candlesticks with a lot of momentum just come crashing down just like this in a few minutes, in a few hours, right? So it's like a very swift move to the downside. And the reason why I deem this pullback as low probability is because of the fact that when this happens, it is often a fake out. It is pretty much like a trap to entice retail traders to enter early, right? To trap the impatient traders. And they might look tempting, right? Because they move very quickly. But more often than not, they will leave you holding a losing position, right? So if you actually enter straight away upon the mitigation of this demand zone, when you see a fast pullback, guess what? You place a stop loss below these lows only for you to get stopped out just for price to go up in your way, right? Because like I said, the market seeks liquidity, and the only liquidity in this case is below this low right here, right? So the market tends to comes down, right? Sweep that low here, grab the available liquidity before the real move actually happens, which is why you entering for a buy at this demand zone right here will not work out. So if you do want to trade fast pullbacks, make sure you enter for longs after liquidity has been taken, after price has swept this previous swing low or swing high. And that is how you can really take advantage of these fast pullbacks. Next, you've got the slow pullbacks, right? These are the slow grinding pullbacks, and they usually tends to be a little bit more choppier. It creates like this stairway step effect sort of thing, right? What I mean by that is that after a break of structure, instead of having like a steep and swift pullback just like this, it creates a very corrective move, right? Price goes down, creates lower high, lower low, which starts at the internal structure has shifted bearish to facilitate the pullback, and is making like a very slow, drastic move to the downside, right? It's very corrective. So if that's the case, this point of interest is most likely going to hold. And that is why I deem this as medium probability, right? Because you can actually enter for longs upon the mitigation of this demand zone, right? Since we have this corrective price movement after some form of liquidity sweep, of course, and it can potentially have a huge upside, right? If you actually try to target this swing high right here, because now we know that this pullback is over and right now price is going to continue to head up. But it is medium probability. It's not high probability because of the fact that the longer price chops just like this, the higher the chance that it's going to break down even further. And what I mean by that is that the longer the price stays in this slow corrective price action right here, the more likely this zone will fail, which means price is just going to blast right through it, swap the liquidity before the real move actually happens, right? So this is a professional tip right there. If you want to trade this slow pullback, right, you want to enter upon the mitigation of this demand zone, you want to make sure that this pullback is not taking way too long, right? It's not taking like weeks or months to actually play out. And finally, the ones that I personally look out for the most, right? The ones that I deem as high probability, which is the liquidity sweep pullbacks, right? Like I said, the market requires liquidity to move. And if there is no liquidity that is formed during the pullback phase, guess what? The only available pullback is during the continuation phase on the left-hand side right here, right? That is why I say that in this case, when there's like a fast pullback, there is no liquidity being formed in the pullback phase, which means the only available liquidity is going to be sitting below this low right here, right? Because that's where the retail traders are placing their stop loss if they're looking for longs over here, right? So that's like the only place that smart money can potentially get liquidity, right? So no big surprises right there when this zone actually fails, when price actually come down to swap this low. But if there is liquidity that is formed during the pullback phase, that changes everything, right? Because now we actually got sufficient liquidity to fuel the continuation move to the upside without depending on liquidity on the left-hand side on the continuation phase below this low here. So what happened in the liquidity sweep pullbacks is that after a break of structure just like this, we have some form of corrective move, right? Price actually starts shifting bearish, creating lower highs and lower lows to facilitate the pullbacks, right? And then as it approached this demand zone that we have marked up that created a break of structure, it starts to create inducements, which is pretty much traps laid by smart money to entice retail traders to enter early, right? To once again trap the impatient traders. Because a lot of impatient traders, they start seeing this double bottom at this demand zone. They start thinking that, oh, because the textbook says so, because this YouTube video says that when you see a double bottom, you should enter for a buy, right? So you enter for a buy right here to place your stop loss below the double bottom, just so that they can give the professional traders, the smart money, the liquidity they need in order to fuel price to the upside, right? So in this particular case, if you enter for longs right here, you are the liquidity, right? Because you can't spot the liquidity. So quick recap, what happened is that price dips enough just to take out the obvious stop losses, right? Clear the liquidity pool and then reverses hard in the entire trend direction. And to me, these are the cleanest setups that you should be waiting for, right? Because this is when price actually respect the structure, right? Creating like a structural high low right here, respect the demand zone after it swept liquidity, and it ties into market psychology as well, right? Because this is the price point where institutions that are looking to get longs after they have swept sufficient liquidity. And yeah, if you got a liquidity sweep just like this, that's pretty much like a green light for you to actually enter for longs, which is why I deem liquidity sweep pullbacks as tier 1, high probability. Now, does this mean that it will always work? No, because like I said, it's high probability. It's not high certainty, right? The market is not certain. Trading is always going to be a game of probabilities. It's never going to be a game of certainty, which means that a lot of times you can see like a liquidity sweep just like this, but then price still go down and sweep this low before the real move actually happens, right? Because there might be insufficient liquidity right here for price to actually move to the upside, right? There might be not enough fuel here, right? So it needed more gas, right? The gas here is not enough. So you need to go to the next gas station to get more gas before you can actually move price to the upside. So it really depends on case-to-case basis, right? But like I said, all we can do as traders is to try to stack as much confluences in our favor by understanding liquidity and inducements. So whenever you're analyzing a setup, don't just ask, is this a pullback? Ask, what type of pullback is this? And trade accordingly, right? Because if it's a fast pullback just like this, we are pretty much expecting price to sweep this low before the real move actually happens. So you're much better off waiting for that low to get taken out and then look for longs. If it's a corrective pullback, if it's a slow pullback, you're much better off entering upon the mitigation of the demand zone after some form of liquidity sweep, maybe right here or something in the pullback phase, right? Just like what we have on the liquidity sweep pullbacks. It depends on case-to-case basis. And the one that I tend to rely the most on is obviously the liquidity sweep pullbacks, where we got some form of liquidity sweep in the pullback phase before the real move actually happens. All right, so now that you know not all pullbacks are created equal, right? You got fast, slow, and liquidity sweep pullbacks. But just knowing the types alone is not enough. You need a mechanical system that is repeatable, that is systematic, that is consistent, which brings me to my playbook, or rather one of the entry models in my playbook called the market mechanics pullback model. Now, I'm a big believer that in trading, if you cannot explain your system in 3 bullet points, you don't actually have one. A lot of trading gurus, they like to complicate their strategy by having like 10 different confluences, 10 different ways to actually enter for a trade. But you must understand that they try to overcomplicate stuff so that they can sell you causes, so that they can actually try to make you buy their signal, buy their holy grail indicator. But like I said, I don't need your money. I'm here to make you a better trader, which is why I want to simplify it into a framework that just works. And it's very simple. It just consists of 3 steps. These 3 steps pretty much allowed me to simplify all this chaos in the market into like a systematic framework which I can just execute every single day. So these are the 3 steps. The first step is to check for buyers, right? And the first step basically requires you to identify the trend direction. Because if we want to trade in alignment with the institutional flow of money, we need to know oh, where is the institutional flow of money, right? Is it causing price to go up or is it causing price to go down? Is it bullish? Is it bearish? Which is why the first step is to confirm the higher time frame trend direction. So if you got price breaking structure to the upside just like this, we know that price is in a bullish market structure. If we see price breaking to the downside just like this, we know that price is in a bearish market structure. All right, so we want to trade in alignment with the higher time frame trend direction. So if that's the case, I want to be looking for longs, right? Because price is just broke structural to the upside. And right now, the next step is to determine the impulse, right? Determine the type of pullback and act accordingly, right? Is it fast pullback? Is it slow pullback? Is it the liquidity sweep pullback? And the thing is, liquidity sweep pullback is pretty much like a variation of the slow pullback if you think about it. Like all we are waiting for is just some of liquidity sweep in the pullback phase, in the slow pullback. That's it, right? And ideally, we want the liquidity sweep to happen near the extreme demand zone, right? Not here, but near the extreme demand zone. This pretty much increase the likelihood of price actually respecting the demand zone and actually continuing to the upside. And then step 3 is where we find the optimum entry point when the pullback is over. The optimum reversal point which allows you to have limited downside and unlimited upside, right? Which is entry upon liquidity sweep, right? You want to wait for price to come down to the demand zone that led to the break of structure. You want to wait for a liquidity sweep to confirm to you that the pullback is over, and this is where you can look for longs. And to give you more flexibility, there is 2 methods that I want to share with you today, and that is the aggressive entry model or the conservative entry model. The aggressive entry model is for people who are more risk-seeking, right? Which means that you can enter immediately upon the liquidation of the lows right here, right? So after the inducement, after the trap has been formed, you wait for price to sweep liquidity, and this is where you enter immediately, right, at the mitigation of this zone, immediately upon the liquidity sweep, right? You don't wait for any confirmation, just enter here and then. Like I said, it's much more risky, right? Because you must understand that there is still a chance that price can just blast right through this low right here, sweep this low before the real move actually happens. Which brings us to the conservative entry model. The conservative entry model is, as the name suggests, is more conservative, right? It's for people who are more risk averse. So if you want to get extra confirmation that the pullback is over, you're much better off going with the conservative entry model, which states that you want to wait for the liquidity sweep, same thing. You want to wait for the mitigation of the zone, but you also want to wait for a market shift, right? Which confirms to you that the pullback is over, the internal structure is shifting bullish, right? Where price actually took out the last internal lower high, and now you wait for price to pull back to the lower time frame demand zone that created the market shift. Then you look for entry on there and you try to buy it and play the continuation. Alright, so that's pretty much the conservative entry model. Now bear in mind that after the market shift, this tells us that the internal structure has shifted from bearish to bullish, which also tells us that the pullback is over, right? So after this, you're pretty much fine, right, to look for longs at all of these higher lows, right, and just play the continuation to the upside. So these are where I deem high probability, right? These are all the high probability setups are sitting at, right? Because this is where internal structure is aligned with the swing structure. Internal structure is bullish, swing structure is also bullish as well, right? And you pretty much will be looking for the exact same pattern, the exact same entry model that we have seen right here, and over here, right? Before you actually entry, right? So after the pullback, wait for liquidity to be built up, wait for liquidity to be swept, look for your entry and play the continuation, right? Same thing right here, so on and so forth. So step 1, the bias check give you context of the market. Step 2, determining impulse give you a filter, right, to prevent you from getting in at the wrong pullback, right, getting in at the wrong liquidity and being the victim of liquidity. And then step 3, this is where you get precision of entries, right? You can find out what is the best time, the best price point to actually look for longs to trade in the continuation of the higher time frame trend. Knowledge is useless if you don't actually apply it. If you just memorize stuff and you just remember stuff, just learn theory, just learn knowledge, you're pretty much mental masturbating if you don't actually apply what you've learned. Right, which is why I want to go through some examples with you. First of all, let's start with NQ, right, which is Nasdaq futures. So in this particular case, what we have was obviously a bullish trend direction, right? You can see price just creating like an uptrend just like this. But you always want to make sure that you follow every single step in the market mechanics pullback model, right? You don't want to miss every single step. You don't want to get complacent. You don't want to think that you know it all. Because if you do that, the market will humble you. So you go from step by step. Step 1, determine bias, right? So we can see that price goes up, creates a very massive, drastic candlestick pullback before it goes up and breaks structure. So clear as day, this is our bullish break of structure. Since we got a bullish break of structure, now we are anticipating price to start pulling back. Now, you might be asking, wait, Brad, why is this not a break of structure? Because we did got price goes up, pulls back, and then goes up and then goes down, right? Now, this is not a valid break of structure because you can see when price actually went up to take out this high here, it created a candlestick wick break. The candlestick did not actually close above the previous high. Unlike this case right here, where you can see the candlestick did close above the previous high, which constitute a valid break of structure, right? They're just like a bonus tip out there for you to identify your structure properly. So after we got a break of structure, now we are anticipating price to start pulling back, which means that the internal structure is going to start shifting bearish to facilitate the pullback, right? Which is why the next step is to determine the type of pullback and act accordingly, right? Is to determine the impulse. So let's take a look at what happened next. Okay, price starts pulling back, right? Giving us a market shift right here. You can see when price actually take out this low right here, which means that price is potentially going to start to create that lower high, lower low dynamic, right? So let's look. Look at this. Very sharp pullback, right? You can see it's not like a corrective move where price does this and then comes down, does this, and then goes down, create lower high, lower low, slowly trigger its way down to this point of interest. No, you can see it's just sharp price movement just like this, right? And it's indicated by very big bearish candlesticks right here, right? Big juicy bearish candlesticks, which is why we are pretty much expecting price to just blast right through this low right here. Like I said earlier, the market requires liquidity to move. So if we were to actually map out our swing low, right, and swing high, we were pretty much expecting price to continue this bullish trend direction, right? Which means we are expecting price to create like a higher low right here before it actually go up and take out this low here. But if there is no corrective pullback, there is no liquidity being built up on the pullback phase, the only available liquidity is going to be below this swing low, right? Because this is where the retail traders who enter for longs right here, trying to trade this bullish market structure, have placed their stop loss. So that is like the only available liquidity right here. So that is where right now we are pretty much expecting price to come down, swap that low before the real move actually happens. Which is why this demand zone that you have marked up right here, that led to the break of structure, is not going to hold. And this is how we really filter traps and legitimate pullbacks, right? So right now, let's just take a look at what happens next, right? You can see sharp price action. This demand zone, price is most likely just gonna blast right through it. Look at this. It did not even like respect it whatsoever. It just boom, blast right through it. And what happens that it blasts right through it is swap the available liquidity that we have below this swing low right here, right? So there, my friend, is a good old friend, liquidity. All right, so once liquidity has been swept just like this is where if you're aggressive, you can look for longs, right? Because like I said, the market only moves once liquidity has been swept, right? So you can easily enter for longs right here and then place a stop loss below the liquidity sweep, right? Below the protected low here, right? And I can potentially target like this high right here or even like this high right here, depending on how you want to enter. Now, if you want to really make your entry more refined, right, you can potentially spot your entry on the 1 minute or the 5 minute time frame, right? So if I go down to the 1 minute time frame itself, I will see that the minute price actually take out that low right there, right? The minute price actually took out this swing low right here, you have easily entered for longs right here, right? And then just target like 2R or 3R or even like the nearest 1 minute supply that we have right here, right? The previous internal low high, just like this. Okay, this will be like a very, very fast TP, right? Because eventually price started going up and up slowly but surely, and it will hit your TP just like this. It's gonna be like a very simple trade, right? You just enter after the liquidity sweep. But like I said, it's very aggressive because there is still a chance that price can potentially come down and swap this low before the real move actually happens, right? Because remember, this is not like a one size fits all strategy. It's not like, okay, liquidity sweep has to get taken right here and then price will move in a way. No, every movement in the market is unique. And until you accept the fact, you will always be trying to find certainty in an uncertain market, right? So yeah, bear in mind that that's the power of liquidity sweep. Understanding liquidity gives you all the tools that you need to kind of spot liquidity so they can perfectly time your entries. But we can never ever predict with 100% certainty where is the final liquidity sweep, the final gas station that the car is going to be stopping at in order to grab fuel before the real move actually happens. So let's say you get out of this trade and I want you guys to observe what happens next, right? Price started consolidating right here, right? Started coming down, right? Chop around here a little bit, right? It doesn't seem to have sufficient momentum to actually cause price to go up here, right? So let's just continue to see what price does on the 15-minute time frame. Right, price started still chopping down. Boom, look at this. Come down here, swap the liquidity below this low here before the real move actually happens. That's why, like I said, you will never ever know with 100% certainty where is the last gas station, right? So in this particular case, the minute price actually came up here, right, started pulling back here, and it pulled back to this previous supply zone that we have marked up right here, and it mitigated that and it started going down here, you already know that there is not sufficient demand in the market in order for price to take out this high right here, which means that it's gonna go out there and search for more liquidity before the real move actually happens. And where is the more liquidity, right? The more liquidity is gonna be below this low here. It's gonna be below all of these lows that we have marked up right here, right? All of this is liquidity, right? So price came down, swept all of that lows, swept this low, and then the real move actually happens, right? But yeah, this is another topic for another day, right? If you want to check out more videos of mine on liquidity, you can just go and search liquidity at the Trading Geek. You'll see a lot of videos on liquidity and inducement traps, right? To prevent you from like this type of situation right here. So let's go back to applying the pullback entry model. Man, I get so passionate about this stuff that sometimes I just go off track. Now, before we move on to the next example, if you're from US or UK, hit that subscribe button right now because I drop advanced setups and strategies just like this every single week. And if you're still unprofitable and you want to scale to 6 or 7 figures with the right mentorship, with the right guidance, check the link below. And bear in mind that this is not for people who are treating trading as a hobby. This is for serious professionals only. Now let's take a look at the next example in a bearish scenario this time, right? So you can see that price goes down, pulls back, goes down and breaks structural, right? So clear as day, this is the last break of structural, which means that this is going to be our swing high and this is going to be our swing low. And the reason why we marked out our swing high and swing low is so that we can really pinpoint our time and energy and attention into just one narrow range, right, where we want to focus on, right? Because this is the present moment, my friend. It's not what price does here or like 5 years ago, but this. And this is what you want to focus on. So over here, price has started pulling back, right? So now, first thing, determine bias. Okay, price is bearish. We want to look for shorts, which means we are expecting price to start pulling back, right? And create like a new lower high right here, and for price to continue going down even further. Now, where is price going to pull back to? Most likely going to pull back to some form of supply zone that we have on the left hand side, right? So if I were to mark up the supply zone, you will mark this entire range up. You can see this entire chop right here, right? By the way, all of these like nuances in terms of like how to mark up your supply and demand zone properly, how to identify liquidity, I have like a very in-depth training on each one of these, right? So if you want to learn more about each, just go and search the Trading Geek plus the concept, right? The Trading Geek supply and demand zone, the Trading Geek liquidity, you'll see a lot of videos on this, right? So over here, this is pretty much the extreme supply zone that led to the break of structural. So now I want to see price actually pull back, respect this point of interest, sweep some liquidity before the real move actually happens. And that is where we want to enter upon, right? Upon the liquidation and the mitigation of the zone, right? So let's just wait and see what happens next, right? Price started pulling back. Okay, you can see this is a corrective pullback. Because if it's a fast and aggressive pullback like what we've seen earlier, price will just like this. It will just go up just like this with very aggressive and big bullish candlesticks. But in this particular case, that's not the case, right? Price is actually like creating very corrective price action, goes up higher highs, higher low, goes up higher highs, higher lows, right? So it's very corrective, it's very slow, which means that we can expect price to actually slowly move up the point of interest, which also means that we can expect this point of interest to hold itself, right? But remember, I only want to enter upon the liquidity sweep, right? The liquidity sweep is the fuel, my friend. So in this particular case, price goes up, creates high highs, pulls back, goes up, pulls back, goes up, creates tiny low pullback, goes up, pulls back, goes up, comes down. Boom. This is where a lot of retail traders entering for a sell right here. Because they mark their, I don't know, supply zone or weird resistance level right here. And then when price actually create like a double top just like this, they immediately start entering for a sell, right? Because you can see this is where you got the initial impulse to the downside, initial selling pressure starting to come into the market. So this is where, once again, is simply a trap, right? To entice the impatient traders to get in for shorts early. So they enter for shorts right here. They place their stop loss above these highs here, above these inducements, above these equal highs, double top, right? Which give us liquidity, right? So that is the available liquidity that we need. So we only enter once that has been swept, right? So in this particular case, you can see the price of liquidity. Yes, it did. Did price mitigate the zone? Yes, it did, right? Is price creating like a lower high right here? Yes, maybe, right? Potentially, this is going to be the low high for price to actually go down and take out this low right here. So when that happens, right, the minute price actually go up there and sweep the liquidity, if you're aggressive, you can immediately enter for a sell right here, right? You can either enter on the 5-minute or the 1-minute time frame, right? But this is where you can start entering for a sell right there. You can either place your stop loss above the point of interest, above this zone right here, or if you are aggressive, you can place it above above this high right here. And this high has now become protected since it's a high that has swept liquidity, which means that price is most likely going to be respecting this high the next time we actually pull back here and actually like continue to the downside, right? So let's see how this trade plays out, right? Boom, smash TP, as simple as that. I forgot to mention, but you can place your TP at fixed 3R just like this, or you can place it at the nearest swing low, right? Which is this low right here, at the nearest internal low, right? Which is this low right here, right? So yeah, get in fast, get out fast, right? Let's see what happens next. I'm just curious, right? I want you guys to observe where price pull back to. Where did price pull back to? If you can see right here, if you are looking for the conservative entry, right? Because you are not comfortable with just entering right here because you are scared that you are gonna be the liquidity. You're scared that you're gonna get stopped out, right? You can go for the conservative entry model, which means wait for the market shift to happen. Now, where's the market shift? The market shift is when price breaks through the last structural low or high. So in this particular case, this is the last structural low, right? This is the last structural low that caused price to go up. So when price come down and take out that last low right here, this is our market shift, which means that this has pretty much confirmed to us that price is actually continuing with the higher time frame order flow, right? The pullback is pretty much over. And if that's the case, your job as a trader who is looking for the conservative entry is to wait for price to pull back to the supply demand zone that created the market shift. And if that's the case, this is the lower time frame supply and demand zone that created the market shift. And if you extend this all the way to the right side and put this to 15-minute supply, you will see that price pretty much came up there, right? Mitigate that supply zone and then push it downside. Okay, you can see right here. Let me just zoom it in for you guys. This entire range would be counted as like the supply zone. All right, so you can see after the market shift, you wait very patiently, right, for price to pull back to the supply zone and then you look for an entry. But pay attention to what price does before you actually get your entry. Price goes down, pulls back, goes down, pulls back, goes down. Once again, enticing the retail traders to enter for shorts early to create available liquidity above these highs right here. It's pretty much the same thing that we have just saw on the higher time frame, but now we are looking at it on the 5-minute time frame. That is why I say price is fractal, right? Like this entry model, this analysis, this process works on every single time frame. It just depends on the lens you perceive the market from, right? So if that's the case, we know that there is available liquidity sitting above this highs here, and you can just enter upon the liquidation of that high right here, upon the mitigation of this zone, and just place your sell order right here. Place your stop loss above, once again, the protected high, the low that stops liquidity, or the lower time frame supply zone, just like this, if you want to play it safe, and then place your target at either this swing low or like this on the next 3R, just like this. Now, for me personally, I'll just place it above the protected high, and I'll place it at the next swing low, just like this. And I want you guys to observe what price does next. That's it. That's it. Do you see that obvious meltdown? Price just absolutely collapsed. And the thing is, where did price pull back to before it collapsed? It pulled back to this supply zone. It pulled back to this protected high because this is the high that swept liquidity, which means this is the high where institutions entered for a large amount of sell position, which means the next time around price actually mitigate this high right here, which is protected, institutions that are going to be loading more sell orders. That is why I got this insane move to the downside. So if you are still not convinced that this entry model works, I don't know what else can convince you, man. Now, before we move on to the next segment, which we go through the most common mistakes that every single retail trader make when they trade this entry model, I want to go through how to use the market mechanics pullback model in stocks. Because stocks work a little bit differently, right? Because there is gaps, and then the New York Stock Exchange open at a specific time compared to the futures market where it's open like 23 hours a day. So there is a few things that you need to tweak in order for you to make sure that this pullback model works for stocks, right? For my fellow stocks traders, if you're watching this, just keep watching, all right? Now for stocks, so the first step is basically still the same, is to check for bias, right? Is to identify the direction of the trend. But you got this additional step if you're trading stocks. You want to make sure that you check the direction of the gap, right? Because at New York Stock Exchange open, which is around 9:30 a.m. Eastern Standard Time, you want to see if price gaps up or gaps down, because the gap has a very big impact on where price is going to hit towards next, or rather where price is going to pull back to in the future. Now, using this example that we can see on the screen right here, we can obviously see that this is a very obvious break of structure to the upside, right? Which means that when price actually took out this previous swing high here, we are expecting price to actually start to pull back, right? And then potentially create like a higher low right here before the real move actually happens. So once again, you can mark up your swing low and your swing high, right? So that is the first step, is to check for bias. No, is to identify the bias, like the higher time frame trend direction. The next thing is to check for the gap direction, right? So this is around Saturday, right? So Monday, when the market opened at around 9:30, right? You can see on the time right below here. This is where we want to see whether price gap down or gap up, right? So let's see. Price goes up. Okay, this is no. Boom. This is where the market actually opened. So when the market actually opened, it actually gapped down, right? And when it gapped down just like this, what does this tell us? This tells us that price is pretty much pulled back to the last higher low, potentially going to create like a new higher low right here after mitigating like this demand that we have right here. And then it's going to start pushing to the upside. And another thing I want you to pay attention to is the fact that it actually pulled back to this gap that we have previously right here. It is not a coincidence. This is what happens when you understand how the market works. It pulled back to the previous gap right here, all right? This was the gap that was formed on Friday, which brings us to the next step, which is to determine the impulse. You must understand that price usually retraces into previous day high or low or point of interest or gap just like this or imbalance. So in this example, notice how price actually pulled back to this previous demand zone that we have marked up right here. And this is also the low of last Friday. You can see last Friday on 22nd August, the lowest point was somewhere around here at 12:30 a.m. Singapore time, right? This was around the 6634 area, right? So we are pretty much expecting price to gravitate towards that area as well, right? So look at what happened next. Eventually, price gaps down. It continued making like a deeper pullback into that last prior day low, and it also mitigates some form of refined demand zone that we have down here, right? So that's pretty much where we're expecting price to pull back towards next, and this acts as a pullback zone, and this is where you want to look for an entry. And the third thing is that you only want to enter upon a liquidity sweep, right? So if there's no liquidity sweep, you don't enter. So this is where if you go down to the 15-minute time frame, you can potentially try to find some form of liquidity sweep. And what do we have here? We got price goes down, consolidate here, gap down, which we assume that is just a pullback, goes up once again, entice retail traders to enter early, and comes down and swap the liquidity from this low before the real move actually happens. And the minute this happens, this is where you can look for your entry right here upon this liquidity sweep right here. Okay, this liquidity sweep here. And also, like I said, price has pretty much mitigated the prior working day, which is last Friday's low right here. And also like the demand zone that was created last Friday that was formed, right? So bear in mind that the reason why we can pretty much depend on price holding this point of interest is because if you look at the left-hand side, last Friday, what happens is that price goes down, pulls back, goes down to this point of interest here, and then it started creating like a gap up just like this, and there's so much imbalance right here, which is pretty much like a sign that institutions that are loading a large amount of buy orders, right? You can see there's a lot of momentum, there's a lot of like bullish buying pressure right here, which means the next time price actually come down to the same price point, institutions, they're going to be scaling in, right? They're going to be loading even more buyer orders, which is why now we're expecting this point of interest to hold, right? So you can easily enter upon the mitigation of this zone, right? Place a stop loss below the protected low, just like this once again, and target like 3R just like this, right? So you can see eventually price slowly go up, hit your TP, as simple as that. So once again, just follow these 3 steps that we have marked out right here, and you can use it. You can apply this pullback model on every single tiny little niche market that you like to gamble in, be it stocks, futures, crypto, Forex, options, whatever they have like a financial chart, commodities, oil, whatever, it will follow these 3 steps. Because these 3 steps is pretty much a reflection of how price move and why the market move the way it does. So as long as it's an asset class in the financial markets, it will follow these 3 steps. All right, now that you've understood what is a pullback, the 3 types of pullback, what is the market mechanics pullback model, how to apply it on futures, stocks, and the countless of chart examples and walkthrough, the next thing I want you to pay attention to is the most common mistakes of pullback trading. If you don't understand these 3 mistakes, you're prone to commit these 3 mistakes and lose a lot of money, right? So make sure you pay attention, right? Because the reality is that most traders, after they watch this lesson, they will just go and butcher this setup because they don't understand these 3 mistakes. The first mistake is entering way too early before structural breaks. It's entering when you see that green or red candlestick upon the mitigation of the demand zone. For example, like this is the demand zone that's created right here, and you see price starts pulling back, right? And the minute price gives you like a green candlestick just like this, you start jumping in too early. Or the minute price starts creating like a candlestick just like this with like a lower wick just like this, you start entering for a buy too early because you mistake this as buying pressure and now you're looking for longs. Just for price to little go down, swap some liquidity before moving in the way that you want it to move, right? So as a result, once again, you became the victim of liquidity. You became the liquidity, my friend. And this creates what I call the death by 1,000 cuts, which basically says that in trading, if you continuously have multiple small losses, it will cause your confidence and your conviction for your trading strategy to erode over time. Which means that over time, if you keep on getting stopped out over and over again by using this entry model, because you're not using it in the right way, the right manner, you will start losing faith in your strategy. You won't trust that this strategy works. And as a result, the next time an opportunity aligns with your trade plan, you hesitate to actually enter into it, right? Because once again, you have been trading it the wrong way. You're making a mistake. No shit, it's not working for you, right? So don't suffer from the death by 1,000 cuts. You're much better off waiting for extra confirmation in terms of a liquidity sweep, in terms of a market shift, to signal to you that the pullback is actually over, right? To signal to you that the internal structure is actually shifting bullish. So the next mistake is pretty much like the same mistake as mistake number one, but it's like another variation, right? It's like mistake number one is where you enter too early because you don't wait for the structural break, right? You don't wait for the internal structure to actually start shifting bullish to confirm you to the pullback is over. Mistake number two is entering without liquidity sweep, entering without the fuel that the market needs in order to drive price upwards. For example, price create like a very corrective pullback just like this to your point of interest, and you start getting impatient. You don't really want to wait for the liquidity sweep, even though Brad explicitly tells you to do so. And you start entering like somewhere around here in the middle of nowhere, and then price comes down sweep liquidity before going your way. And you wonder like why this setup doesn't work. And they keep on saying, Brad, the setup works, but I always get stopped out. Well, because smart money, they haven't cleared weak hands yet. So you will the weak hand, right? If you actually get in too early without some form of liquidity sweep, right? So that's why I always say, always, no matter how confident you are, no matter how many confluences you have in your trade ideal, wait for the liquidity sweep, right? Because the market is pretty much a machine where it transfers wealth from the impatient to the impatient, right? So if you are impatient, you are pretty much going to be transferring your money to me, right? Which is the patient guy. Now, the final mistake that people make is trading pullback during low liquidity hours. To me, I define low liquidity hours as lunch hours in the United States, which is around 11:30 a.m. to 1:30 p.m. Eastern Standard Time. This is where the Wall Street traders, the professional traders, the hedge fund managers, they're going for a lunch, they're enjoying their fancy steak in an expensive steakhouse. They're not going to be at the desk, right? If they're not going to be on the desk, there's not going to be much volume in the market. There's not going to be institutional volume which you can ride on, which means there is not going to be much opportunities, right? Which means you're going to get chopped in the ugly, choppy price action instead of getting like very clean retracements, right? You're going to get a lot of like false signal. So you're much better off just preserving your capital for the volatile hours, right? For the hours of the market where there is actually opportunity in the market. And it could be the New York Open, it could be after the lunchtime, but just do not trade during the lunch hours itself. It's like you're going to risk the same amount of money anyways. Like no matter what time you trade, you're going to be risking the same amount of money if you are trading professionally. Why not just risk that same amount of money at a good time where it can give you like an asymmetric risk to reward, where it can give you like a very huge reward potential. And that time is not when the traders are having lunch. It's when they are active in the market. That is those times where it will give you like the most amount of opportunities, which will give you like asymmetric risk to reward trades. Now, before we end this video, I want to give you guys like one final advice, right? Because if you're watching it all the way until the end, you are a trader who's committed, you want to become profitable, you want to become consistent, but you are not doing sufficient reps. Like after you watch this video, you think that, oh, after I executed the market mechanics pullback model and I win one trade, that means this strategy works. That means I've cracked the code. This is the holy grail strategy. When in reality, that's not true. Because the truth is, if you just rely on one setup working, guess what? The next time it fails, you will not have conviction in it. And that's really because you don't earn conviction in a setup until you have stress tested it enough. Now, how do you develop undeniable conviction and confidence in your strategy and your edge? Well, you perform what I call the rule of 100, which states that you don't deserve to feel confident if you haven't reviewed 100 trades. Not take 100 trades, but recorded and reviewed 100 trades. That's the minimum size that tells you whether your strategy works or not. Not after one trade, not after 20 trades, but over 100 trades. And the reason why I developed this rule is because people severely underestimate the amount of volume and time it takes to develop confidence in your strategy. One of my students recently asked me, hey Brad, why have I not figured out the market yet? I've been trading for 1 month. I asked him, alright John, how many trades have you taken so far? He replied, 10 trades per month. How many did you take in your first year of trading? I told him, in my first year of trading, I took 100 trades per month. That's 3 to 4 trades per day. And then he didn't reply. He just nodded and he said, wow, okay, cool. Thank you. I'll do more. So understand that most traders severely underestimate the amount of data it requires to get proficient at trading. The reason why I got good at trading in the first 3 years, or I got proficient at trading and got competent, is because I did 10 times more work. If you think about it, I took 100 trades while he took 10 trades per month. As a result of doing 10 times more work, I was able to gather 10 times more data than he did, which means that I was able to get like a faster feedback loop because I know what I was doing wrong and what I was doing right because I've been testing the strategy on so many trades per day, which also means that I got sufficient feedback to actually reiterate my trade plan, reiterate my trade strategy to actually do more of what works and less of what doesn't. And that allowed me to just really get good at trading and actually see results. So if you are new to trading and you want to develop conviction, you want to see whether your strategy works or not, take 100 trades. Be it in live market conditions or demo trading or back tests or forward tests or chart exercises, whatever it is, just execute 100 trades in according to your trade plan. And then what you want to do is to track every single trade. The entry, the exit, the R multiple, the win rate, and you want to evaluate the results. What are your strengths? What are your weaknesses? What do you do well? What do you do bad, right? What are the things that actually work within your trade plan? What are the things that doesn't really work? And just eliminate those stuff that doesn't work and just do more of the stuff that actually works. And then only after 100 trades, you can judge yourself, your strategy, and you can build conviction in your edge. So until you hit that threshold, your brain will always doubt, right? You will always struggle to enter for a trade when it lines up with a trade plan. When you see it in the market, you will always hesitate because once again, you haven't put in sufficient volume in order for you to build undeniable confidence in your edge. So how do you expect to actually trust your strategy and become profitable when you haven't put in the reps? When you haven't gathered sufficient evidence to prove your strategy actually works? Because remember, nothing in the market is free. Profits cost discipline. Consistency costs time. Mastery costs practice. If you haven't put in the work, stop complaining about the results you're not getting. If you're not willing to pay the price, stop complaining about the outcomes you have never earned. It's like buying a new iPhone 17. The iPhone 17 has a price, right? It's like you decide whether you want to pay the price or not. If you don't pay the price, then you don't enjoy the benefits of the iPhone 17, right? The new camera, like the weird orange color. But then if you're willing to pay the price, you are willing to incur the cost of that product, then by all means, go and enjoy the iPhone. It's the same thing right here. If you want to become profitable at trading, you have to incur the work. The work needs to get done. That's the cost it takes to achieve monumental success in this particular endeavor. So the next time you complain about inconsistency, ask yourself, have I took 100 trades? Have I recorded 100 trades? Have I reviewed 100 trades? If not, then you got more work to do because the work isn't done until the rule of 100 is met. Alright, so if you've enjoyed this video, you will love a free course that I've put together for you right here. Once again, I don't need your money. I just want you to become a better trader, right? Just gonna watch this video next. And as always, remember, you're just one trade away.